So, a warm welcome to everybody outside and inside the ESBG WSBI headquarters here in Rue Marie-Thérèse. We welcome you all, 360 participants from all over Europe online and around 40 here in the room live to some kind of a premiere. Most of you have heard of Spotlight before, a series that we created many years before, reflecting over current legislative files. Now we changed the modalities a little bit. We started directly coming out with a Spotlight edition after some very, very important legislative files are published. And we plan to do so also in the future. This gives us all the possibility to hear, when everything is very fresh, directly what is the reason behind, what are the intentions, what are the key aims of the one who produced this, who came up with this, and two of the key actors of the PSD3, the PSR, the Digital Euro Regulation, and the Financial Data Access Regulation that had been published today. Jan Zeissens and Eric de Colombier from the DG FISMA, from the European Commission, are today with us. Thank you very much for joining us. It's great to have you here. And you can imagine 400 people all over Europe are now really keen to listen what you have to say to us. The moderation today are very well experienced. Most of you know him probably very well. Head of the Payment and Innovation Department, Diederik, will lead you through this afternoon. Enjoy, take lots of information with us, and join us also the next time. My name is Peter Simon, Managing Director of ESBG, and all the ones out, I hope to meet live soon. Thank you.
Thanks, Peter, and also on behalf of me, a warm welcome to Erik, Jan, the people here in the room, and the people in the audience online. You're now the guest of ESBG, the European Savings and Retail Banking Group, which is the association for the locally focused, responsible savings and retail banks that have represented countries all over Europe. But we are not here to talk about ESBG. It's called a Spotlight event, which means we put external stakeholders or internal stakeholders, depending on what you call it, or close friends into the spotlight. So we really want to give the floor to the guests of honor that we have here today, both Erik from the Retail Financial Services and Payments Unit in DG FISMA, as well as Jan Zeissens from the Digital Finance Unit, also at FISMA, here with this very timely event. We all have seen yesterday the publication of the long-awaited legislative proposal that Peter mentioned. On top of that, there was also a proposal on cash. I think it was a quite cliffhanger in the run-up to all these events with leaked versions. Would the Digital Euro proposal be on the table or not? And in the end, it came back and not again and back. And at the end of the day, we have a full package, which not of all had time to read in detail. At least I'm not so also happy to have the two of you here to give some very necessary voice over to all these pieces that came out. Before we dive into the content, both for the people here in the room, please be as silent as possible, because we have only one mic that picks up any side, and otherwise the people online will not be able to hear our guest. For the people online, you have the possibility also to ask questions via the questions button that some of you already found, I see here. And also in the chat, you can obtain technical support if you need so. But having said that, let's move on to the content. And without further ado, I will start with Erik, because I know he has more engagements like this today, and he has to leave us shortly before 2:30. Erik, what can you tell us about the files that at least fall under your remit and that has sent you out yesterday?
Thank you, Diederik. Thank you for this invitation, and good afternoon, everyone. So yes, the long-awaited day has come yesterday, and we all feel on our side 10 kilos lighter this morning. You can see how relaxed Jan and I are all these times, and we are all the people, journeys and holidays for us now. Tonight will be your turn. Sorry to destroy your summer with beach time reading. Hope you will enjoy it. Yes, I will speak mostly about the PSD, PSR. I appreciate the fact that you have not yet been able to read the final versions. You have seen leaked versions indeed. And you may have seen perhaps that we have, in the meantime, refined quite a number of things. So on PSD, PSR, I think the master word or the master expression is evolution, no revolution. It's been, I think, said by our political masters yesterday in the press conference, and I think this, well, I know it is exactly how we would describe this package. We are not turning the table. We are not, delivering brand new proposals, and so because we have done a very extensive review of PSD2, review which actually you can read in the package. It is, I would say, a handy summarized version of what is in fact in the proposals, and it explains the why. So it's our review of PSD2. It has gone perhaps largely unnoticed because, I mean, of course, everyone has focused on the two proposals, but there is this review report, reading of which I would recommend. But this review, which we have conducted with my team over the past 2 years, has revealed to us that PSD2, by and large, has been efficient and effective in fulfilling its main objectives. But that being said, we have nevertheless deemed it indispensable to proceed to some modifications, some revisions, some adjustments to PSD2, mostly as regards fraud and as regards open banking. And again, not with brand new fundamentals, but with nevertheless significant, let's say, changes compared with PSD2. So I would say the main features of this package, PSD2, PSD3 now, we can call it PSD3 and PSR, which we don't call PSR1 because we don't know whether there will be a PSR2, but who knows in future if there will be one. So this package, I would say, there are four main pillars. The first pillar is fraud, fight against fraud. And why is it a pillar? Well, it probably was a pillar under PSD2 already with SCA, with a strong customer authentication. But since PSD2 was adopted, fraud has transformed, has morphed, and the techniques that are applied by fraudsters now are only partly addressed with SCA. Fraud is more and more based on manipulation, on tricks, and this is what we've tried to address, but I will come back to that in a moment. So fraud, number one pillar, I would say. Prevention and redress, I will come to that in a moment. Open banking, what have we done? We have not changed the basis on which open banking was built in PSD2, which is no indispensable contractual relationship between TPPs and the banks, and therefore no remuneration model between TPPs and banks. And I know, and I expect reactions to that in a moment. I know that that was not your wish. I'm saying that to the banking side of the audience. That was not your wish. You would have liked to have, unlike in PSD2, a possibility to charge TPPs, which we have not, after lengthy discussions, which you will find in the impact assessment, which makes another good reading, but it's 200 pages, so that's a warning of heavy stuff. So we have, in open banking, we have not changed the fundamentals, but we have, I would say, improved substantially the functioning, the data access that TPPs can legitimately expect to find when accessing an interface in the context of open banking. So that's the second pillar. The third pillar is what I would call the level playing field. In PSD2, well, in fact, the source of the problem was not really in PSD2, but in other pieces of EU law. But we had a situation whereby the non-banks had difficulties to access payment systems. They could not be participants to direct to payment systems, and they had to rely on the bank in order to to piggyback and be able to access payment system. And that has been one of the main novelties of PSD3. It's to give to the TPPs, to the fintechs, to the non-banks, the possibility of, under some conditions as always, to have access to the payment systems. And we are also going to improve the possibilities for these non-banks, the payment institutions, to open a bank account. There was a provision in PSD, which was Article 36 of PSD2, which has not been working very well, as our review has revealed. That was also something confirmed by the EBA in an opinion, and so we are doing something about that. And last but not least, we have tried to improve what I would call the transparency, the rights, transparency and rights and obligations of customers, consumers in payments, when receiving payment services. So we have improved the situation as regards their possibilities, for example, to perform SCA, because we have received, believe me, a number of complaints where people were unable to do SCA because they didn't have the right technology, the right device. They were supposed to have a smartphone, or they had a physical condition which made that difficult. So we've heard the call, and we have some rules about that in the text. We've also improved situations, for example, where customers have their funds temporarily blocked. For example, at a hotel, before checkout, the hotel does not always know how much it will cost. So there's an amount of money which is blocked. Sometimes at fuel stations it's the same. So we are also here improving the situation. We are also giving more transparency to customers, consumers, where, for example, they are doing international transfer, and we are trying to improve their capacity to judge how much it will cost and how long it will take. And we are also giving them more information about ATM withdrawals, about how much it will cost them. So these are, pell-mell a few issues. So I realize I've gone already into the substance for all these 4 pillars. But I believe, I'm here with Nuno from my team. We believe in the Commission that we have a balanced package. It is something where there is something in it for everyone. I'm sure you've all heard my good colleague Dirk Houbrich in the EBA. He always starts his presentation saying, "I'm here to make everyone equally unhappy." and I used to think it was not a very a very nice thing, but now I would be tempted maybe to apply the same thing. We are the European Commission. We're not the European Commission of banks or fintechs or consumers. We are the Commission of everyone, and we've tried to come up with a balanced package because we are convinced that this is the good basis. Believe me, it represents more than 2, if not more, years of work. So none of this comes out of thin air. It is something which has been thought through, reflected upon. You may disagree with it, and that's very fine. This is we are Europe. We can discuss these things, and I'm actually looking forward to discussing all these things with you. This is our deliverable, but now, as you will all be familiar with how things work in speaking for the non-EU who might be joining us online, we are now going to have a scrutiny of these texts by the European Parliament and by the Council. And we know very well in the Commission that our text is going to be, not going to say butchered, but it's going to be scrutinized and modified, and that's fine. That's normal. If we don't like that, we should do another job. So we know that we are impatient to start engaging with the Parliament and with the Council. That does not mean we are going to stop engaging with you all. Of course not. But clearly the center of gravity of this moves a bit away from us and to the co-legislators. But as you know, we are still going to play a prominent role there. So I'm happy to go in more details about all this. I'm sure that on fraud, on the refund side of things, I'm sure you have some questions, and I'm happy to answer these questions. I still have about 13 minutes. That should be fine.
So let's instead of moving to Jan first, indeed, rightfully that you mentioned fraud, and use my executive privilege as a moderator to ask the first question before opening the floor to the audience on the particular topic of fraud. And there are some quite strong refund rights for consumers in there, or refund obligations for PSPs in the PSR proposed at the moment. Sometimes even in cases which I believe banks would even beyond banks' control. Right? Why can it be possible that someone who is not even in a position of something preventing to happen be on the hook for refunding the consumer? And of course, there are some ways out, as I understand. One of them, for example, if the bank or the PSP can prove gross negligence, and it would also be great if you could say a little bit about what that contains, how a bank can prove that, and whatever.
Yeah, fraud. I mentioned fraud as the #1 concern. For very understandable reasons. Fraud, we are addressing fraud in two ways. One way, and the main way, it's prevention. I would say that the best fraud is the fraud that never took place because it was prevented. And this is the ideal world. It might be too idealistic, but it is what we are aiming for, that prevention would capture the largest part of fraud. So prevention remains our #1 tool. Prevention will be based on enhanced tools, enhanced weapons, I could even say. The first one will be the extension to non-instant credit transfers of the IBAN name check, the confirmation of payee. We are going to extend that and import that concept, which we have already proposed in instant payments regulation. We are going to bring that within the scope of PSR. So that means not only instant payments, but every credit transfer will have to be submitted to this rapid, almost immediate, instant confirmation of payee system. So that's a powerful tool. It doesn't capture everything. We know that. It's a panoply. None of these things are in itself a silver bullet against fraud. But okay, first thing is IBAN name check. Second thing is something that the banks had been calling for. It's the possibility for the banks to be able to share fraud-related data between themselves without breaching GDPR. That is considered to be a very important tool for you, banks, to have a better way of tracking, of identifying, detecting where there is a fraudulent transaction or a fraudulent player in their, within their customers. So that's the second thing. The third thing is we are going to invite the banks to significantly improve their customers' awareness. Information is key. People should be educated. I'm not saying that in a pejorative way or condescending way. Should be educated to recognizing a fraud. But okay, this and of course there are other things like SCA. Of course, SCA remains. SCA, we are clarifying SCA. We are trying to eliminate the uncertainties about some situations which which we know we are not very clear in the PSD2. So SCA remains part of this, but SCA, as we all know, is incapable, unfortunately, of addressing these manipulative, fraudulent transactions because they have been subjected to SCA. They have been authorized because the person thought in good faith that he or she or they were dealing with a legitimate counterpart, which wasn't the case. So prevention remains number one. When prevention has not been effective or efficient, then there is a fraud. There is a fraud, and in these fraudulent cases, we've tried to see, right, what could be the situations where the bank could have done something about it, and we came up with two provisions in PSR. One is if this IBAN name check system didn't work. If it should have worked, it didn't work, it didn't produce the result it was supposed to produce. Someone was led to believe it was a fine transaction and the IBAN and the name match. So, but in fact, there should have been a signal. Mm-hmm. So that's a deficiency. That's a dysfunction, malfunctioning liability is there. Logical liability, which we have already, by the way, in the instant payment proposal. And the second situation, which I think is the one you have in mind, Diederik, it's the spoofing cases. Spoofing cases, I think you all know, and I'm sure everyone here in this room has been one day victim of this. People, fraudsters impersonating a legitimate merchant or company. And in this case, we've addressed bank impersonation, bank employee impersonation cases, where someone, a fraudster, has, I never managed to say that in English, usurped. I know the word exists, but help if someone can say how it is rightly.
It's correct.
It's correct. Someone has usurped the name of a bank staff, and even more perverse, the telephone number, via means which shouldn't be possible, but are possible technically. I don't know how. So I receive a phone call from someone I know because the name is familiar to me, my bank staff calling me from the bank official call line, and then the perversion is terrible because these people will tell me, oh well, you are actually a victim of a fraud. We are going to try for it not to happen. So I'm completely tricked, and my level of vigilance is very low, and I do it. I click, and that's my doom. Of course, how would I know? So
and how would the bank know?
Exactly. Well, that's my point. Well, that is going to be my point. There are two victims there. There's the customer, and in a way, the bank.
Yep.
But who can really do something about that? I mean, who is best placed to do something about that? I mean, customers, they are vulnerable. I mean, we are talking about people here, who, I mean, yeah, they felt they were tricked. They were led to believe it was a legitimate transaction. It was not. So, I mean, it is difficult for anyone to say to the customer, well, tough luck for you. You've authorized that transaction. You should have been a bit more careful. You should have realized it was a fraud. So here, I don't think we can any longer say these kind of things. It worked under PSD where what was unauthorized was clearly unauthorized because your card was stolen. How could you have ever authorize that? No, of course it was stolen. But here, we are sometimes in a zone where the borderline between unauthorized and authorized is blurred, because of course technically you've authorized that in good faith, but you've authorized it on premises which are tricky, manipulative. So our view is that although the banks can be considered as victims as well of this spoofing because of this usurpation, still we have the feeling that the banks, with their capacity, with their power, with their with their strength, can prevent in the future these things with the telcos, because here the telephone line, well, should not have been so easily available for use. So the telcos have to do something about that. And in the PSR, we've actually put some provisions about that, obliging the telcos to cooperate with the bank to find solutions, to put an end to this. So, and we will be happy in due course to play our role there, to facilitate these, this meeting of two worlds, the telcos and the banks, because they are the ones who can have the solution. But this is a payment services regulation. It's not addressed to telcos. We are not regulating telcos in there. So we've given a liability to the bank with some exceptions. Fraudster being himself, herself, involved in a scam, gross negligence. And we have even put something in a recital, which I would recommend you to read. We've said that gross negligence, of course, it is something which is civil law. It depends on circumstances. But we've put somewhere in a recital, I don't know exactly the number by heart, but it is a recital which says that if you are tricked twice by the same scam, with the same bank, with the same modus operandi, can you still claim that you are not negligent? So that could be if you want. But we are not going to force the courts or whoever to say that. But we say that in our view, it might be difficult to plead no gross negligence where you are a second time round victim of the same spoofing fraud from your bank. So in a way, once bitten, you should be twice shy, as the English say. So, but that's our mitigants, if you wish, of that. But still, we believe, I mean, if the banks don't have this skin in the game, this risk of liability, which we hope will be as reduced as possible because of prevention. If you don't have this skin in the game, what would be the incentive to actually do really something about it? So that fear of liability, which can be extensive, you never know, which can be extensive, should be a real motive to go and do something about it, because customers won't be able to do something about it. They are so in a way, within the world of victims, there is a victim that can do little about it apart from being more vigilant. But these are very sophisticated tricks. And there is a victim, the bank, that has the power to do something about it. And that's the message that we want to send.
Thanks, Eric. We will study it in detail and see what can be done with it. I'm not sure whether there's a question here from the audience. If not, there's at least here is a question online. It's about the IBAN name check. It's coming from CE countries. I suppose these CE countries don't have it implemented yet within the 18 months that is foreseen at the moment. After entering the force of the PSR, what would happen then with transactions to and from those countries?
Also, we are here in a scenario where the deadline will not have been met.
Yeah.
And then what happens? Well, that's a breach. I mean, because of course the consumers, since it is a regulation, consumers derive direct rights from the regulation, and there are corresponding direct obligations upon the PSPs. So there will be a liability issue here, of course, for having failed to apply the rule. Of course, we know, that, I mean, if we want this to work cross-border, there has to be, let's call it a scheme, and there are, as you may know, already some discussions to find collectively a solution to make this IBAN name check system work cross-border. There are already some IBAN name check systems that exist in some member states at different levels and of sophistication, of performance, with different features. Sometimes I was told recently that there are about 10 systems 10 such systems. I was aware of less, but so that means we need an EU solution there, and we are going to promote with the industry the emergence of an EU solution for that.
Okay, thanks. Then another question is related to the settlement finality directive. I see online. Apparently, the co-legislators in the Parliament yesterday in the Econ committee, when discussing their positions for the instant payments regulation, decided in their wisdom to open it up to other entities than banks. From your point of view, would that be something that would further be covered in the current discussions or the work that you have been done on the PSD3 PSR? Or
I mean, we are in favor of that being done. So access to payment systems by non-banks. The reason why we had not put it in the instant payment proposal was because it is not an instant payment specific issue. And our intention was always to put it in PSD3, which we have. So it is one of the last articles of the PSD3. But like you, I'm informed that the Econ has voted in favor of having this done via the instant payment proposal. I mean, let's see first what the Council will say, because this, for the moment, is the position of the Parliament. I know that in the Council, some member states had already expressed interest for that. So let's see whether, but it is not in the Council mandate. Let's see whether this agreement comes out of the trilogues, of the future trilogues. If it does, then of course the Commission will have to pronounce itself. And I'm pretty sure we will be in favor of doing that because it will come sooner. Because we are already at the end of the instant payment negotiation phase, whereas for PSD it hasn't started. So if we want this new rule to arrive sooner than later, then it would be better to have it put in the instant payment regulation. So I'm pretty sure, I can't commit the Commission here, but I'm pretty sure the Commission would accept this.
okay, then maybe one last question for you before we move to Jon. And you mentioned already trilogues and the further legislative process. When can we expect these two files to land and being published in the official journal of the Union? And you will get the same question later as well.
I will answer as Eric answers now.
So, is that a crystal ball?
Well,
Is it crystal? Is it a ball? No.
yes, probably the same answer.
Right. No. When do you expect? The question is, when do we expect these proposals to be adopted? And yeah. All right. Next year will be election year for the Parliament, for the European Parliament. So, okay, what we could expect is to have by May or June of next year, June I would say, a council mandate. On the Parliament side, it's a bit more of a question mark because it depends how much time the Parliament will need to appoint rapporteurs. That is entirely their cuisine, but my hope is that they will be able to appoint a rapporteur or rapporteurs. I mean, imminently, before July would be ideal. September would still be fine, and then start immediately the work. In which case, who knows? We could have also a kind of first reading, or yeah, we could have a negotiation mandate of the Parliament in June of next year, and then there would be election time, and the new Parliament would have to be put in place, and then trilogues could be held at the end of 24. This is probably an optimistic scenario, but let's see. For example, the Parliament has already appointed a rapporteur for the retail investment strategy just a month after it was adopted. So who knows? Maybe they will also want to have progressed on these files. But yeah, but there are many files to progress on. There will be the digital euro. There will be the open finance. There will be the cash regulation. So yeah, we are competing with other files, and let's see. But one cannot expect, of course, these files to be finally adopted by the end of the Commission's mandate at the end of 24. I don't think so. I would like it, but I think it's a bit optimistic. So my reasonable guess, but don't take that as a commitment because I cannot control much of all this. It's first half of 2025. Probably towards the end of the first half of 2025 under Polish presidency.
Okay, thank you. We will only know by then and at that moment. But thanks
I'm not taking bets on that.
these insights. We're not taking bets. We're not going to make an appointment to be in the same room at the same time. What time from here from now? But so thanks for these insights. I'm not sure whether you already have to leave now or not. Or
I will ask Nuno to come and sit here.
But then we shift to Jan, who also has some files in his portfolio. On the one hand, the digital euro one, and the other one, the FIDA, or the they still need to get used to abbreviation because until the run up before it was really on the agenda, it was still the OFF and Open Finance Framework. So if I say Open Finance Framework, please allow me. But I don't know which of the two regulations you want to present first. But happy to hear your initial remarks, Jan.
Yeah, maybe I can then start off as we have the PSD before. I can then start off with indeed FIDA with Open Finance, because in a way it is also, let's say, a logical next step, building also on the experience of the PSD, more particular concerning actually access to customer data. So this is indeed, let's say, a complementary proposal to the PSD in the sense that it, let's say, covers actually customer data in the financial sector beyond payments. So payments data is today subject to the PSD and will remain there. And Eric has explained indeed what are the changes there. I think the framework which we've proposed now, which is the so-called Financial Data Access Regulation, will indeed then cover that part of customer data which is not related to payments. So that means more general, say, savings accounts data, that means insurance data, investment data, occupational pensions. And this is part of, I think, a broader effort we've made also in the financial sector. This mandate actually to also encourage and support data-driven innovation. And you know, I think various other projects, for example, just mentioning the European Single Access Point for public disclosures, but also the work on supervisory data we've been doing and others. And of course, all of this is also part of the broader European data strategy. And Data Act trilogue was just concluded, I think, 2 days ago, one day before indeed we made our proposal here. I think that's also a nice signal to show that indeed the proposals we are doing here, they're in a way also part and parcel of this and building on this broader framework, which also indeed ensures actually a cross-sectoral approach based on the various building blocks. And then I think you know what are the, let's say, parallel measures we've been taking in other sectors. Now let's maybe take, let's say, 2-3 kind of focus particular on FIDA. What are the objectives here? And I think this is again quite not dissimilar to the objectives we had with PSD actually when it was PSD2 when it was proposed at the time and now refined. It's really about, let's say, putting on the one hand, making sure that customers are indeed in control of their data. It's the well-known principle of the data protection regulation, the GDPR. And secondly, indeed, to also allow where customers so want actually to ensure effective access to data for third-party data users if customers decide to want to benefit from innovative products. So we've had a flying change here. I think now it's all good again. So it's really these two elements. On the one hand, to this kind of confidence and of consumers and customers to make sure that they really see that they're in control of their data. And on the other hand, indeed, for those customers who actually want to access innovative products, are willing to also and want to share their data for that with third-party users actually to make this sharing also possible, as it has also been the case under PSD2. Now, how do we actually then concretely approach this? Indeed, as I mentioned, the scope of this regulation covers broadly, I think, customer data in the financial sector. We have also indeed, of course, built certain of the safeguards which we have here, really very much on the experience of the PSD. First of all, indeed, let's say data access is something which is and should remain within the realm of authorized and licensed institutions. We have in the PSD, you know, the account information service providers who can access data, other credit institutions, other financial institutions can access data. And I think the same principle we've also then now introduced for financial data sharing beyond payments, indeed, only licensed financial institutions. And that includes here then also a newly authorized actually financial information service providers, FISP then we would call them. I think you already see a quite close similarity to the account information service providers. Only those licensed financial institutions actually are able to access data. As you know, these are all and will also all be subject, of course, to common rules on operational resilience, data security under the DORA framework. I think that's also an important safeguard here. Yeah, so I think that is one of the safeguards actually we've included. I think another one again is quite similar to also what the work which is now being done in the PSD3. The idea to introduce indeed so-called permission dashboards actually. I think also this one, as quite a number of these ideas, actually, you may recognize that also ideas and approaches which the expert group, which we had which had worked for us together with us actually until last autumn, had come up with basically. So quite a number of ideas and thoughts which people there indeed from the banking sector, from the consumers, from the insurance sectors and others had come up with. And indeed, I think there also this idea of permission dashboards actually got quite some support and was actually suggested. So I think that's another safeguard which should really actually indeed underpin this idea that customers should also be knowingly in control of knowing and understanding actually who has access, whom have they given access to their data, and indeed also being able then to control that relatively easily via a dashboard. Now, we think beyond that, still, I think when it comes to data access and to data sharing, there are some specific risks in certain parts of the financial sector, especially where actually products are really essential for also participation in general in general life, and where then otherwise, if there's no access, actually there are risks of financial exclusion. Now, I mean, we think that on the one hand, actually data-driven products can actually promote on quite a number of occasions financial inclusion. But of course, there can also be risks that, let's say, data poor people or maybe people, customers who do not want to share their data actually may have more difficulties in accessing data. And for that, accessing financial products. And for that reason, I think we have actually excluded from the scope of the regulation a number of, let's say, data sets, in particular data arising from creditworthiness assessments for individuals, and data relating to health and life insurance. So those, let's say, data sets arising from these areas actually are not covered by the regulation, are not then also subject to data access and data sharing. And on the other hand, indeed, we have also, again, based on the work of the expert group, some suggestions there from more the consumer protection experts as well, have established clear principles, what we call the data use parameters, which establish quite clearly that data use actually is limited to what is necessary indeed to pursue certain, to provide certain products. And again, in those areas actually where we see potential financial exclusion risks, indeed, the EBA and EIOPA will then be tasked actually to make a bit more clear and concrete what that means, and indeed what can be guidelines also for financial institutions actually to use data. Nothing which is completely new. Indeed, I think the EBA in the loan origination guidelines had already done the first step in that direction, but I think we find it well useful, actually a useful approach and something to build on. So I think that those are a bit some of the safeguards we propose indeed to make sure that data is in control of customers, and we have also, let's say, a broader level playing field here. We have no, say, undercutting of standards or others. Let's look then maybe a bit at what do we propose actually to enable also data access and data sharing. Indeed, I think we propose here that financial institutions in the mentioned areas actually must in principle grant access to data to the customers in electronic form. That is now nothing revolutionary, especially for the banking sector, but maybe a bit more interesting for some other parts of the financial sector. But then indeed also must, if the customer so agrees, actually grant access indeed also to other financial institutions providing services to this customer or to third-party providers. In a way, I think that principle is again something which is quite similar to the PSD and also to the Data Act. I think when it comes to the implementation, we have maybe, let's say, after long consideration and again also taking into account a bit what the expert group had told us, interestingly actually, that where we had a quite unanimous actually view from all the stakeholders that actually maybe data sharing going forward in areas beyond the payment service directive, that data sharing should maybe also be let's say based a bit more on economic incentives and also contractual approaches, and a bit less indeed on command and control or compliance culture. And in that spirit, actually, when it comes to the implementation of the data access, that's probably a bit of a new approach, but again, a bit comparable maybe to the Data Act. Actually, we would provide indeed in the proposal that this such Data Act, where there is a principal obligation to grant data access, the exercise of this would then be subject to a contract between both sides, and also to subject to reasonable compensation actually for making the data available, not for the data itself, because of course this is the customer's data, but indeed let's say for the making available of the data. We propose indeed to avoid that hundreds and thousands of bilateral contracts actually would have to be concluded. We do propose indeed that market participants should be subject or should be participating in financial data sharing schemes, which I think if you look at that, surely recognize a bit the inspiration we took from the work in the EPC and other fora actually, which we find very valuable. And we hope that this, let's say, approach will actually, let's say, will then be, I mean, the way to implement actually these relatively general and principled obligations which are set out in the framework. There is a fallback there should that not work. So, I mean, in that case, then you would not have no other way than for the Commission to come in with a delegated act. But I think in principle, the starting point of the regulation is that actually we put quite a lot of trust and emphasis here on the market, actually on the different market players in a way, both when it comes indeed to the contractual arrangements and also again to standardization, where in that case, in line with the PSD, we don't go into a lot of detail on data standardization and API standardization, but leave that really to the market. We are also not prescribing that there should be just one single standard or one single actually data sharing scheme, but we leave that also to the market. We think it's could actually maybe, depending on how the things develop, could be also interesting if maybe also competing schemes actually appear, or maybe some more sectoral actually schemes in some parts of the financial sector. So that all that would actually be left to the market if you want. Yeah, so that's a bit the approach which we've been proposing on financial data access. Should I go also to the Euro?
Maybe two short
Exactly. Let's maybe stick to that first, because otherwise I speak too long and it gets just boring.
The first question, I'll take two questions from the ones online. The first is a couple of questions that are coming from Shields and Roman. It's about the authorization regime. Maybe it's a bit for both of you, because now we have AISPs and FISPs. They will be both subject to authorization regimes. What are the difference there and what's not? Will there be some similarities or not? That's the first question. And the second question is also maybe a bit for the both of you. In your case, there was some compensation being discussed for the access of data, whilst the PSR didn't dare to enter into that territory. Maybe not sure who of the two want to go first on those two questions.
I can maybe start and then you compliment.
And by the way, you're welcome. Thank you for stepping in.
My boss played the trick on me.
Eric had to bail out, but no, it's a nice replacement.
Yeah. No, I mean, I think on the first two important questions, and thank you, Gilles, actually for also your input on this. I think the proposal we've made on the financial information service providers, we strove to make it very, very coherent, if not largely similar to the account information service providers. Now, it is always, even in the Commission, sometimes a struggle to keep the coherence. We had, so you may, I will not exclude that you may find one word here or there in the text where basically maybe our lawyer linguists have insisted in one case to do it like this and the other like that. But the idea was to be very, very similar. And actually, of course, ASPs would also count as licensed entities under FIDA framework, basically. So an ASP license or a credit institution, of course, would not have to have an additional license under FIDA. We had also at some point considered even to kind of to merge both the licensing regimes, but probably we thought, okay, on balance, I mean, the ASP and the payment institution license is a well-working framework. Basically, we don't want to now disrupt that, let's say, for something which is not actually even there, really, basically. So that's why I think we decided to keep both, but it's really interoperable. And on the actually the data sharing model, let's say also the compensation, there indeed, you rightly pointed out that for the open finance part, we go a bit of a different way. I think I explained why we thought this was a useful way, but I think, and then we will complement, again, the PSD works now, and let's say what we do, what we propose on open finance is also a bit of an experiment. Let's put it like this, in a way. I think we take a bit at face value what actually many stakeholders told us, put more confidence in us, and don't regulate everything, don't go into all the detail, basically. And if you create incentives, then it can also work without detailed standards, etc. But it's a bit of an experiment, and let's say probably for everybody involved, given the amount of work and time which went into the PSD2 implementation already, it would probably not be a wise choice to basically now change this all over again and go for a different approach. I mean, it's one thing if you start something from a clean slate. It's another thing if, let's say, investments have been made, let's say, also people that the market has kind of, it's based on a certain model, and to then completely change that, I think that is probably quite a different approach. Is that, from your perspective?
I mean, I would start by quoting my own boss, which said that, this revision package is an evolution and not a revolution. I mean, on compensation, you are aware of the huge debates that you also have with EGCOM. And the debates are also going on internally, it's fair to say. And so basically the approach taken under the PSR is basically based on what the evaluation of PSD2 was. And so the evaluation showed that PSD2 and the framework for TPPs to operate is working. So I don't think that the compensation is the issue here. I know that some might disagree. There are some lack of incentives, according to some, but I mean, this was not flagged horizontally as the key issue. And so also in line with the competition, I wouldn't call them concerns, but the competition considerations that any piece of legislation has to take on board. We chose to keep the framework that was already in the PSD2, which is no need for a contract, no need for compensation. I mean, absent evidence that this is an issue, I think that was the right approach, of course, but this is going to be subject to council negotiations, and let's see what comes out of that. We coordinated quite closely with Jan's team. And I mean, the fact that we are keeping the baseline approach and the PSD2 doesn't mean that, as you have in the FIDA proposal, that compensation and potentially a scheme could not be there for the various services. On so that's my punchline, I guess.
Time for this, you're almost.
On the authorization regime for AISPs, I mean, again, we follow the same logic. AISPs, we actually discussed whether they should be kept under PSD3 or if they should be moved all along to the FIDA framework. But I think time will tell. I hope I'm not misquoting my own review clause, but I think this will be subject to evaluation sooner rather than later, I think. We also have a lighter regime under PSD3 for account information service providers, whereby you basically have to register with your home member state, and you are not subject to EISPs are not subject to authorization, so to speak, the usual framework that other payment institutions are subject to. I mean, the criteria here was the same that was already there under PSD2, which is there is no movement of funds. I think this was the main criteria to have this lighter regime applicable to EISP, so to speak.
Thanks, Nuno. Then digital euro maybe. We heard yesterday your political master explain that it's not you introducing the digital euro, right? So that's also clear for the audience. But you just lay the foundations should the people in Frankfurt and the Wisdom decide to issue one. But happy to hear what you created for them or proposed for them for the rollout or the possible rollout.
Indeed. So I think you are all aware of the project which the ECB has ongoing on the digital euro. And I think it has become clear since quite some time that indeed the introduction of the digital euro is retail digital euro is a quite fundamental choice, actually, which both legally requires some adjustments and also I think politically needs to be a choice made by the legislator in the end, by the European Parliament and the Council of Ministers, because it is a quite fundamental choice. That is in that sense basically the background of the proposals we have presented yesterday. Our commissioners have presented yesterday, which are indeed, let's say, an essential condition, a necessary condition for the digital euro to be issued. Actually, in that sense, basically, yes. Once the legislation is adopted, it would still be up to the ECB to decide when is the right moment to issue, and there can be many considerations. And I think that's also right. I mean, technology needs to be ready, and other considerations as well. But indeed, I think that the principal discussion whether, let's say, a digital euro should as such be established is something which is for the legislator. Yeah, and I think that's the proposals which we've made yesterday. I think you probably all know the discussion around the pros and cons of retail digital euro, so maybe I will not go on that one now into detail. I think also our commissioners have explained yesterday quite well why they think actually retail digital euro would be something wishful to establish. Maybe let's look a bit at what these proposals actually we have made, what they contain in a way. And I think the broader challenge here is, of course, to provide for a legislative framework where, let's say, key policy choices and regulatory ones are made. But in a way, on the other hand, you don't kind of prejudge the technology, which will be evolving. You don't basically go into all technical details, which I think are then better actually done by central banks, simply because the legislator is, as we always know, is relatively slow. Is also not the right one in terms of expertise actually to make, for example, detailed technical design choices. But of course, the legislator still will want to, and I think also for good reasons, will want to give the ECB the guiding principles in a way, and to make sure that it establishes in a way that what the digital euro actually is, the retail digital euro, and how it should be used. And I think that's what the legislation does, or the proposal actually. So it establishes the digital euro both in an online and offline form. It also has to be very clear on that, basically. Again, to be relatively close to cash. I think that's probably the overarching principle. Digital euro is not the same as cash. The moment you move something from paper to digital, we all know that it has quite a number of implications, but it is certainly made to be as close as possible to cash, or as similar as possible actually to cash. And that means, of course, also that distribution is indeed then will be done through the payment service providers. Actually will also on the banking side be obliged to actually to make the digital euro accessible. The digital euro on the side of merchants will have to be accepted, so it will have a legal tender status with some exemptions. And on the client side, basically, so the client will get access to the digital euro via the commercial banks indeed. So clients of commercial banks will have this possibility in a way to have an additional choice actually to use the digital euro. It will always remain a choice. It is not an obligation for anybody. So it's an additional possibility. And I think to actually also underline this, you know that we also presented indeed a proposal which will also enshrine actually the legal tender nature of cash. as well. That was also presented yesterday. So to make very clear that indeed the purpose of the digital euro is not to replace cash, but we need to complement it for those citizens who, as we know, there are more and more who really want to pay digitally and who want to maybe not want to pay cash anymore, but still may want to have access to public money. I think I leave it maybe at that, and then we can rather go in some questions, because otherwise I speak too long.
No, that's fine. And maybe I will start with the first question, and it's basically about you already hinted a little bit about the compensation model. We understand a couple of things. Banks are the lucky ones that are in the privileged position to distribute it to their consumers, which is great, of course. We also understand that for basic usage, we have to provide it for free. Okay, interesting. There is some wording around an inter-PSP fee, without going into the detail there, apart from it's restricted to, should not be, or at least the merchant service charges are restricted to existing caps with comparable means of payments. It's quite a lot of detail in there, quite some reporting being expected at some point in time. But who's going actually to set the model, how would it look like, and at the end of the day, well, what's in it for banks?
Yeah, so I think that's of course an important one, because indeed, if banks should distribute the digital euro, I mean, there needs to be something in for them into it. Well, I mean, I think from the broader perspective, I think the availability of an additional actually means of payment, also especially for cross-border payments, is something which is interesting also from the perspective of the banking sector. I think that we already find with actually with instant payments, which provides an additional choice. The euro will provide an additional one, and hopefully also support maybe the further rollout of instant payments. But I think that's certainly an important point. But then, of course, you also look at well, the money side, well, what comes in terms of actual money. And so I think it's important to stress, indeed, the digital euro services as such are, let's say, basic services would be free for use. I mean, we think that this is quite similar actually to the situation concerning cash. Actually, I would say not everywhere in Europe, but I think by and large, let's say, in most banking relationships, client relationships, access to cash is not a value-added service which you have to pay in a dedicated manner, at least under conditions. And again, I know that the situation is not the same everywhere, but in principle that is the case, and I think that should also be the case for the digital euro. But indeed, it's the digital euro services which are the specific retail services which are free of charge. Of course, it's then, I mean, the establishment of the basic customer relationship is, I think, another matter. And indeed, then there would be, I think, the possibility, I mean, that is ultimately also for the market to see, but there would be a possibility indeed for an interchange actually to model also to exist under this regulation. Limited to a certain extent, like also interchange today is limited to a certain extent. But that would indeed, I think, then be, and the reason for that would precisely be also to ensure actually that banks are remunerated, because of course the basic services would indeed be for free. I think another possibility, of course, in terms of let's say commercial interest on the banking sector would of course be then to provide value-added services, more innovative payment means where that's actually desirable. So I think those are a bit the incentive factors. Now, I mean, you will of course for banks, it will in the end be interesting to see, well, how does that compare to what they have today? And I think the answer is not straightforward, and I cannot give you a detailed calculation on that, because I think there's still some unknown factors, of course. But there are, of course, some factors that indeed, let's say, I mean, in principle, the digital euro infrastructure, and also I think some of the, let's say, services which today, for example, payment schemes are providing against a fee to the banks, will be actually provided and financed by the ECB. So in principle, I think on the cost side, actually, there will be, let's say, areas where there will be less cost, than that's going to be the case for let's say, some existing private means of payment, card schemes. So I think that is certainly something to be seen. Then on the revenue side, indeed, okay, we have the fee for basic use. However, I would argue that, well, really, it's not so different from, I mean, the way most banks function today for cash. So in that sense, that should probably not make such a big difference. Yeah, so overall, I think that's roughly where we are. But very important, of course, again, here the legislation sets principles. I think, of course, then the detail here will also have to be worked out the parties. So how have we done that here? We have very clear actually principles on the compensation in the regulation. And then it's a principle first and foremost for the market actually to also find the right approaches here. But the ECB will then regularly actually report actually and monitor actually that the principles which are in the regulation, so that in principle that actually that compensation should not go beyond cost and reasonable profit, and that basically it should not be more expensive than comparable means of payment. So the ECB will monitor that these principles are actually abided by.
Yeah, that's interesting, and maybe one more question still from my end. But if you look, let's say comparable means of payments, I think given the fact that most of the use cases seem to revolve around retail payments, so we can probably compare it most to card payments, which is as the underlying business model is kept by DG competition, especially with debit for 20 basis points. But there are also some countries like Belgium and the Netherlands, to name a few, that have a much lower cap. And assume that also then in that particular case with DGO, those lower caps for them apply as well. Wouldn't that put those banks at a disadvantage for implementing this product?
No, I think we would look at this from the on a European perspective, basically. So it would be, I mean, it's a difficult question because in principle, I mean, very easily you can start and say banks should be not worse or not better off than they are today with means of payment, basically. But of course, then when you go to details, it's not so easy to implement this principle. And we think that for the euro, it would be only fair to have indeed let's say a common approach here, basically. So indeed, I mean, this comparison to existing means of payment would have to be done at the European level.
Okay, then maybe a bit more concept type of a question. What caused all the confusion about whether the proposal would be published yesterday or not? There was some.
I think, yeah, there were a couple of points which caused. I think one of the very simple points was that in one of the press materials, actually, there was only the press conference on PSD and open finance mentioned, not the other one. I don't know why that was the case, but I mean, look, it's. I honestly don't know why that. I was also yesterday some messages from people who said, "Oh, is it off the last minute?" I thought, "Is it off without me knowing?" But I mean, then I saw the commissioners coming into the press room, so I thought, "Okay, probably not. They should know." So.
It was worth to wait, and also already.
No, but I think maybe on this one, I mean, from our perspective, it is important that these proposals are now out because I mean, this will put the whole discussion on a very much more concrete footing, basically. And we know this is the start of a debate, that also our commissioner said yesterday. So this is not the end of the debate, and it's going to be a thorough debate, but it is important. Sometimes the debate so far was a bit ending up a bit in general principles, and I think now with this proposal on the table, it will become much more concrete, and I think that's also important to move the debate forward, basically.
Speaking of those debates, the same question as we asked Eric about the possible timelines.
I will not cannot add anything to what Eric said. So anyway, not up to us.
Would the FIDA be earlier than the digital euro, you think?
Look, it's speculation and it's not in our hands. So what should we say?
No, that's a good. Then there's a question from the audience about the number or several digital euro payment accounts that seem to be have been different over time. And what's your view on that? How many accounts? And I haven't looked at the last version of the proposal.
It would be possible to have more than one account, indeed. And so, let's say there is, of course, and now we didn't speak about that, but it's of course an important part as well. There are, of course, the safeguards actually in the proposal to limit the impact on financial stability and credit intermediation. So, I mean, the euro should be first and foremost like cash means of payment and not a store of value. And I think we have quite a number of safeguards in the proposal to that. First of all, that actually the euro would not be remunerated. I think that's a quite important economic incentive. But second, also then a requirement on the ECB actually to develop indeed additional tools to limit negative impact on credit intermediation. And of course, holding limits are, let's say, one of the tools which are the obvious tools which are there basically. And so in that sense, then if you have two digital euro accounts and if there were holding limits, then you as a consumer, you would need to decide, well, how much of that do you put on one and how much do you put on the other? Basically, that would be a practical matter of implementation. Maybe one other point I want to mention there as well, we find it quite important actually that the digital euro, and that's also very clear in the legislation, to use it as a means of payment, it will possible and will be easy without let's say any holding on your digital euro account basically, because of this waterfall mechanisms and reverse waterfall, basically, which are also enshrined in the proposal, you can make payments even if your euro account is at zero. So because then the money will automatically be funded from your commercial bank account, and then when it comes back to your account, it can automatically be defunded to your commercial bank account. I think that's also an additional actually tool which is very important to work, and also work, let's say, without additional costs, because indeed it means that people won't need to have any euro holdings actually to use the euro as a means of payment. And again, I think that's an important tool actually to avoid that this becomes really to a large extent a store of value instrument, and then could have negative impact on banks' balance sheets. This is a point which we have also analyzed in quite a bit of detail in the impact assessment. I'm sure that you have not yet read that, but have a close look. And I think we also try to go a bit more into detail to at a more disaggregate level, basically to examine the effects, because we heard, of course, your concerns as well that, let's say, the aggregate euro area level analysis doesn't really show, let's say, the specific effects on the ground. So I think we have done quite a lot of analysis on this, and that was also the basis on which we then indeed, let's say, included all these additional tools actually here in the proposal.
Thanks, Jan. I'm not sure whether someone in the audience has a question or lots of questions. I'll start with Lita.
Thank you very much, Jan. I just have questions going back to this data on the data sharing schemes. Could you please give a bit of background on why 18 months was chosen as the date to form schemes? Because obviously it's a big undertaking, so I just wanted to get your feedback on why that was the design plan.
Well, first of all, the good thing is that especially the banking sector will not start from scratch, because you have advanced projects running, which hopefully will materialize soon. And so in that sense, I mean, we also think that, I mean, you don't have to reinvent the wheel, I mean, once you've invented it once, basically. So that will give a bit of time. I mean, in that sense, it's 18 months, but 18 months as of the date of entry into force of this regulation, which will be, of course, taking a bit of time, which brings us then to the timeline. But okay, you know all how long it takes here, basically. I mean, we think 18 months, you are right, it is ambitious, but we think it is possible, it is feasible. That's why we went for that, basically. Okay, I cannot give you a scientific evidence that 18 months is the exact right period for that.
There's a related question from the audience. How does it work in practice with those schemes? Is a bank required to be a member of multiple schemes? So will there be some interoperability with schemes? How do you see that developing?
Yeah, this of course introduces a bit of complexity. I mean, it would be easier to simply say, well, per sector you have to have one scheme and full stop. But we did want to actually allow a bit more flexibility here. So, I mean, and the principle, of course, of these schemes must be that they must be open to participation from all market, let's say, participants based on objective criteria. So, in a way, in that sense, basically, I mean, as a financial institution, you should be subject of one scheme. And given that that scheme is then open for, let's say, other institutions, fintechs, to adhere, basically, indeed, if fintechs want to have access to the data which you have, they will need to be part of that scheme then as well. So you don't have to be part of multiple schemes or duplicate that in a way. How will it be in practice? I mean, I don't know that. We don't expect that we will have a large number of schemes, because of course also the development costs and maintenance costs of this are not small. So we would also not be surprised if in the end we will end up just with one scheme or one scheme actually per sector, basically. But we just didn't want to prescribe it, because also it depends a bit on the different parts of the financial sector where the situation is quite different as well.
For one question online, a bit for the two of you, you mentioned that for no data for creditworthiness checking and whatever. Whilst in the payment PSD2, PSD3, you could argue that some payments initiation service providers are combining basically the AISP and PSP service to do some kind of, I wouldn't say creditworthiness checking, but maybe extending some kind of buy now, pay later service, or make sure that money is there.
It's just important. So what I said and what the proposal says, what is excluded is data arising from the creditworthiness assessment. So it is essentially the creditworthiness assessment file as such is not subject to the sharing. It is not. We do not exclude that the data which comes from other sources is used actually for the purpose of creditworthiness, and that's, I think, more the latter case which you described.
Okay.
Actually, don't have anything to add.
And maybe one last, three questions from the audience, and then we call it a day. You go first, please.
I wonder,
the idea of one person being allowed to have more than one wallet. What were your thoughts behind that? And also, I asked that in the context of in originally the Eurosystem, or the ECB, the Eurosystem were not supposed to get personal data from the users of the digital euro, but if they have to monitor the holding limit, and people have more than 2 accounts, so the Eurosystem needs to get the personal data to monitor the holding limit. So how does it fit with the original idea of the Eurosystem not getting the data?
So, first of all, why do we propose that? Because I think we see that quite a number of Europeans have actually more than one bank account, and that tends simply also to reflect this there as well. How does that then work in terms of the data protection? Well, in any event, let's say when you open a digital euro account, a checking will have to be done, because the bank will always have to check whether actually that person has a digital euro account with another bank, basically. Whether you have one account or more, that checking will always have to be done. But it is a checking which, it is not data which is at that moment accessible to the ECB. Basically, it is, let's say, a data exchange between the banks in a way. So, the rails will be provided, but the data exchange here is only between actually the banks concerned. So essentially, you as a customer, I go to, let's say, to Dieterich's bank and tell I want to open my digital. I have a commercial bank account with you. I want to add a digital euro wallet, and then indeed, Dieterich's bank will have to actually do the check with this kind of central system with all other banks, actually, whether let's say whether I have a digital euro account with another bank. That would have to be done in any event. And then if then another bank responds and says yes, he has already an account here, then and I say I still want to have a second one with you, then I will have to decide how I put how I divide my holding limits, basically. Then if the holding limit was 100, then I say, okay, I want to have 50 of it with the Dieterich and 50 with the other bank, basically. And then I think, then it's over the exchange of data, basically. Then
on a daily basis.
The limits are monitored by the bank, by the commercial bank, actually. Okay. Yeah, the limits are monitored by the commercial bank.
I see some challenges in the technical implementation, but let's discuss that online. The last question from Farid.
Hello. So Farid Ali from the Cooperative Banks European Association. I have a question for you, Jan. Thank you very much for explaining all the provisions. So according to Commission proposal that we still need to digest, the ECB would issue a standalone app that users can use also instead of commercial interfaces. Then public entities would distribute digital euro to EU citizens. Next, PSPs would have an obligation to distribute digital euro to citizens. Merchants will have an obligation to accept digital euro. Digital euro services would be provided free of charge to citizens. Maybe you can comment how all these obligations and provisions comply or are in line with the idea of not crowding out the commercial payment solutions and also provide level playing field. Thank you.
Well, not crowding out banks, I think, is obvious, because the banks, as you just read out, are at the core and center of the whole system, basically. When it comes to commercial payment solutions, that's, I think, maybe probably the question. It remains in the end always the choice of the client and the customer what to use, basically. In that sense, I'm personally not sure how this will all end up, basically, because existing payments solutions exist. They have, decades of experience of say advantages as well. So we don't really see that that people will necessarily all move in masses to the euro. In that sense, we don't really see a particular issue there. I think one particular point also we want to particular, of course, because we have a standing policy also to support actually instant payment solutions. So there will be a particular also a particular obligation in the let's say a requirement in the regulation actually for the ECB to ensure wherever possible actually interoperability also between the standards for the digital euro and indeed private solutions like instant payments. So wherever possible, the ECB should actually leverage on standards developed there as well, and should also seek to actually make available any additional standards developed for the digital euro actually also to private means of payment. So actually, we think that the digital euro not only would probably not crowd out private means of payment, but it would probably also even enable some of them in a way. And looking a bit at the overall development of the market, I mean, the market will anyway grow because people are, I mean, assuming the trends continue as they have been continuing, people will use less and less cash. That means more commercial and electronic payments. I mean, it's a growing market. That's maybe another factor where probably the concern that would crowd out private means of payments, from our perspective, not one.
I mean, I don't want to meddle in your.
No, go ahead.
proposal, but
I mean,
it's-
we've worked on that together. So
that goes
go ahead.
back to the discussion that we were having on compensation. I mean, you have a similar cap, so to speak, for the digital euro and for other similar commercial offerings for payments. And then competition kicks in terms of quality of service. I mean, it's how you prevent crowding out private initiatives or private solutions from the market. I think that's the starting point. And our proposal and the Commission proposal is that the level of compensation is there in a balanced way. It's comparable, so to speak. So the rest is quality of service, I would say.
Thank you. And think on that bombshell we can wrap up this event. Quite intentful. I think on the payment related advice, I would help at least it's an evolution rather than a revolution. On the data access, it almost sounds like a big sandbox and experiment and something else. But I think the devil will be in the detail.
We try to take seriously the concerns, but we said, well, try to do it, evolve, try to think outside the box, and put a lot of kind of responsibility also on the market. I think we took that up. So.
Okay, so thanks Jan for being with us, and thank you Nuno and Foxy Erik also for being with us. Very much appreciated. And again, also for the people online, thanks for being here with us, as well as for the people here in the room. We will continue to organize these types of events going forward, and we'll keep you posted on that. Thank you very much. Have a nice afternoon. Take care. Bye bye.
Thanks.